Hey everybody, we're back with another Q&A. What's going on, James?
Hey Brad. Nice to jump on again.
Yeah, for sure. These are always enjoyable. So, one of the topics we're going to discuss is give a few examples on a chart of some miniature systems. So, James, do you mind if I share something?
Yeah, no, bring it
Just
up.
kind of get going. Okay,
Go
so
for it.
I'm going to share. Let's share today's chart here. James, can you see my screen?
Yes. Yeah, I gotcha.
Awesome. So this is obviously today's E-mini, and we can ignore a lot of these lines. Let me just get rid of a few of them. By the way, whenever you have a strong rally, midpoint of the day, whenever you get a deep pullback, it's always a magnet. You can see we closed right around it. But the main thing I wanted to show is right here, bar 14 and 15. I've talked about it a couple times, but it's a term. Ali calls it an always in flip. And what it means is the always in direction is shifting. If you listen to Al would call it something to do with a surprise breakout. And it's a strong enough move in one direction that you're going to get a second leg. So down here, you can see we gapped down below a lot of the lows, below several lows. You can see it up here, tight trading range. And we're in a tight trading range right here. So we're in breakout mode. You can argue, if you're just looking at the moving average, that's typically a pretty good way to measure trends. We're below the moving average for a lot of bars. It's probably always in short, even though this is a trading range and it's not a great swing trading environment. But you see right here, bar 14 is breaking far above the moving average. That's probably strong enough to flip the market to always in long. Some traders will wait for follow through since it's an outside bar. But when you look at this bar, it's closing far above the moving average. Chances are it's going to get a second leg. Now, because it's an outside bar, some traders, I know James, you've mentioned this quite a bit, some traders will ignore outside bars if they're breakouts. Here, we have a giant follow through bar. Traders can buy this close, even though it's really extreme. If they buy and trade small, they can scale in because the probability is very high that you are going to get a second leg. Even if you get a big bear bar, traders buy, they scale in lower. Some traders get out break even, others hold for a second leg up. And I think that's one of the best breakout trades traders can start with. It's when the market breaks far above or below the moving average. Here, we're selling off. It's not clearly always in short. It's a tight channel. And one of the ways I like to view this is whenever I'm looking to sell a breakout, I want to see, especially if we're in a bull rally or bull trend, at least from the standpoint of the open, I want to see a strong breakout, one or two bars closing far below the moving average before I start selling. Just like right here, I want to see one or two strong bull bars closing far above the moving average before I start buying. And there's several, and this last thing I'll say with it, there's several other things. So if you're building a system or thinking about a system, you might think, okay, this is a trading range. I'm going to trade really small, maybe a 20% position, and then I'm going to add on 50% down. The other thing, if you listen to Ali, he's mentioned this several times. When you get climactic bars, usually they pull back before they rally.
Nice. Yeah, so my breakout code slightly adjusted from the one that Ali uses.
You want to share it?
Yeah, I'm bringing this up. I'm going to turn off some signals that I have on the chart since they're a little bit confusing. Here we are. All right. Can you see this? All right. I can actually make this. Let me make the non-signal bars a bit darker. All right. So yeah, so outside bar here. This is a. I'm not sure what the z-score is, but the odds of this becoming a. And so I think the other thing here was that it's a complete wedge. So
James,
outside
if you don't mind
bar.
me asking, can you explain what a z-score is for those listening?
Yeah, so a z-score is basically a statistical measurement. It's basically a standardized or normalized standard distribution. So basically, you take your standard distribution and you set a 0 point, and then you measure away from that in either negative or positive to see how far the whatever your input is deviates from that standardized normalized 0 point. So basically, if you were just looking at standard deviations, you can get some really wonky and not terribly useful numbers. But if you normalize them, then measuring away from that 0 point gives you a much more usable figure. And so, for example, I think this is. Let me see if I display it. Okay, yeah. So this is a. This is a z-score of more than 3, which is very extreme. I mean, obviously, everyone can tell it's a big bar, but typically your ranges for z-score would be between 1 and 2, 2 and 3, and between 2 and 3 is a pretty extreme.
So when you say it's
z-score.
3, you're saying that means there's a statistical valid reason to believe that the market's going to pull back?
Well, 2 things: that it's going to pull back, and that you're going to get trend resumption. And you could have it could be simply a vacuum test, and this is also a very large, statistically significant bar. This one is also more than 3. It's 3.3 for a z-score, but rather than getting trend resumption, all it got was the retest. And this is likely because we're still in a bull regime on the daily, and this is a likely sell vacuum test of any number of different levels down here. The previous day's low, the opening range. So there's lots down here for testing. You have this breakout point, although that was already retested. So in any case, this is your 2 different expressions of actually the same principle. So big breakout with statistical significance. So over 3. I mean, over 1 would be statistically significant, but these are enormous breakouts. However, context and regime is better. In this case, right? This is the first full bar above the EMA. This is after many bars below the EMA.
Mm-hmm.
And so this is kind of also a breakout in the direction of this wedge here. So higher probability that you're going to get, climactic selling and exhaustion rather than, trend resumption. So this is, like Brad, you were saying, this is a regime, an all-in direction flip. The market typically is not going to flip back, after just changing its all-in direction. And so, or always in direction. So in this case, like you said, you're scaling in for trend resumption. In this case, it's profit taking for everyone who was able to participate in this, this move down, and then, obviously trading range into end of day, and the trend and trading range signals that I talked about the other day did a pretty good job of managing this. I mean, these are still unoptimized signals, but if you look at the chart based on whether a bar is a trend or a trading range bar, use that as your first principle. It definitely also gives you good context for understanding those breakouts, because even if you enter a trading range after a big breakout here, even if this one didn't get trend resumption, odds of retesting here, I mean, that's at least one good trade. You don't need to participate in all of this. You don't need to, try to get more than that. I mean, these are 2 very potential trades.
So James, question for you. When you were early in Systems Academy, how soon did you start looking at Z-score?
It was before the end of the year, so probably maybe November-ish. So we started in September, so 3 or 4 months.
Mm-hmm. And better yet, so when you were looking at bar, trying to read the screen, that's bar 15 is the big bull bar, right?
Sorry, yeah.
Yeah, no, you're good. When did you start deciding? Did you ever build a rule in your system? Okay, if the bar has too big of a range, you're not going to trade it, or you're going to look to buy a pullback compared to the prior bars.
Yeah, I mean, I wouldn't buy the close here because when you have a Z-score of greater than 3, the odds of getting a pullback are substantially higher than if it's just between 1 and 2. So I would be looking to buy at 50%. And
and it's
yeah. And when you have a solid bar with it's open is the high and close is the low, then odds are you're testing below that as well. So I would be buying below this bar.
And that's interesting. You're very, and I agree with that. The logic makes perfect sense, but you're very confident in that answer. And obviously you spend a lot of time testing that premise.
Well, I mean, yeah, I spent a lot of time with Z scores, and actually most of it was because when I was discussing them and talking through it with Ali, I was getting different figures. So he was, and I've talked to a number of people about using Z-score as well. And one of the other gentlemen from our class, Abdul, who had some really inspiring ways of using them, we spoke a lot about them as well. And it was funny because both he and I were developing our Z-score algorithms, and talking with Ali about it. And Ali was sharing his Z-score output, not his code, because he wanted us to figure it out for ourselves. And so we did, but our numbers kept coming out wrong, like they're totally different. And it was because he was using a different input. So his system had the ability to use different inputs to calculate the Z-score. And we were using different inputs. And so as soon as we recalibrated, Abdul and I had been working from the proper math, but just using different inputs. So he was looking at body range and we were looking at full range. That was the only difference. And there's different reasons for using each of those calculations. But so this, what we're talking about here, what we're looking at here is full range Z-score.
And for those that are, I think one short topic, and by the way, feel free to ask questions for those that are listening, and we'll be happy to discuss it. I want to tie in for a second why Z-score matters when you're thinking about a trading range. A Z-score, and James, you tell me if you agree or you disagree with the logic here. A Z-score, when I think of a Z-score or a range of a bar, I think of the climactic behavior of a move. So when you have a trend, a trading range is full of trends on smaller time frames. So a 5-minute chart, when we look at this day on a 60-minute chart, we can see that over the past 3 trading days, we've had a lot of trading range behavior, even though it's big swings on a 5-minute chart. But a trend, for it to be sustainable and last, it needs to be contained within a channel. It needs to be non-parabolic. The more parabolic a move becomes, the less traders are going to be willing to trade it. For example, I think the sell-off, James, you pointed out, is at bar 43. Can you highlight the big bear bar for everybody?
Yeah.
When you look at bar, or just hover your mouse over it. Oh, you've actually got a high. Nice. Okay. Yeah, I'm not used to trading view. But right there's a great example. That bar is so big, nobody wants to sell. If you didn't sell early during bar closer to the moving average, maybe whatever the big bear bar is, the first bear bar below the moving average completely, so about 4 or 5 bars ago. Yeah, if you hadn't already sold by that point, I think it's really difficult to convince yourself to sell later in the move because most traders want to take profits by the time you get the big bear bar. So when you look at that move, and it's the same thing with the move up, the Z-score is just saying that the market is becoming too climactic and unsustainable. And when you have something that becomes too parabolic, nobody is going to be willing to sell until there's a pullback. And then by the time in a trading range, by the time you get the pullback, it's often too extreme where you get a second leg. The other thing, and that's really common, and I would assume this happens a lot with Z-scores, is I believe, I forget how many bars down, the bull bar, what is it, bar 40? Is that the bull bar closing on its high? Yeah. How many bars in the micro channel? Bars 28. I think was it 28 to 40? Am I reading those numbers right?
It was 28 to 40. Yeah, so we got 12 bars.
So how many bars is that? That's a good number.
12.
That's 12 bars. 12 bar micro channels, as everybody knows, if you've listened to Al or you've looked at the market long enough, that's pretty extreme behavior. And whenever you get a Z-score, if you get a big Z-score, I'm sure by the late in a move after a 12 bar micro channel, there's no way you're going to want to sell. You might sell a pullback for a quick scalp, but you're not going to be establishing a short position. So James, I got to, my question with this really is, when you look at, can we search any day on, can we look at Z-scores on any day? If I give you a day, can you type it in and look at the Z-score?
Yeah. So I've started using TradeStation for this specific reason. The biggest limitation to TradingView is that it has a 20,000 bar history for any time frame you're on.
Understandable.
So I can go back 20,000 bars. So we got some history, but not.
But if I gave you a day like April 18th of 22, let me just make sure that's the right day, because I would love to see this from this standpoint. So can we go to? Let's see here. I think I've made. Can you go to April 28th of 2022 by chance?
Let's see if that is within the.
And I'm stealing this day from Ali. He talked about it in one of the Saturday sessions about a strong breakout. That looks like, that's recent.
That reset. Sorry.
So April 28th of 22.
So no.
That's okay.
November 22nd is the.
So let's do this. I'm going to share. That is not a problem. I'm going to share my screen real quick. And I'm sure we can, I just want to get your opinion on hypothetically what you think the what the Z-score range would be if we just had to guess. It's on this breakout. So I'm going to share my screen in just a second.
While we're waiting for that, you can see here, this day had very extreme, this is, well, actually, the interesting thing is, when you have subsequent big bars, the Z-score drops, for each subsequently large bar, because it's measuring against a look back period, whatever the user defines. So, this big bar is, 2.5 Z-score, and this one is only 1, even though it's about the same size.
And so why is that?
Because this large, because at least the look back I use is a 20 period look back. And so it is the normalized standard deviation is getting significantly increased because of that previously very large bar. So it's changing the point of comparison. So subsequently large bars are not going to be as, they're not going to have as high of a Z-score. So if you have like a big breakout and then you get follow through, which is much less common, like this was not the high probability events of getting a big breakout and then getting another big bar. When that happens, the second bar is going to have a lower z-score, even if it's the same size.
Makes sense.
So I'll stop sharing and you can.
No, you're good. Yeah, I can go right here. So let me just got this added. So James, I want to get your opinion. You can see this chart, right?
Mm-hmm.
When you look at these bars 33 to 39, this area right here, if you had to guess, would these be a low z-score?
I think I know why you're sharing this chart.
Why is that?
This was one of the examples where the z-score for the body range was high, I believe, and it's in the middle.
No, and maybe.
I think because it's so like if you look, so none of those would be large. I don't believe for the full range.
Mm-hmm.
But one of the things that I found really interesting is when you have a lot of small bars, especially with a lot of wicks, and then you get subsequently small bars, but strong, like full bars, like we see here. Those will actually if you're looking at the z-score of the body rather than the z-score of the full range, those will generate tradable z-score signals.
Makes sense. And so when you have a tradable, so in this example, based on the systems you've built with z-score, what would your system tell you to do here as far as when you're saying tradable z-score signals?
Well, so you have, is that bar 33 is the bull breakout?
Bar 33 is right here.
Okay. Yeah. The second bar after that, I mean, I'm not sure what if you were using a strict z-score system, probably one of those two bars would end up becoming a z-score bar. And the one caveat so if it's 1 to 2 standard deviations or 1 to 2 normalized standard deviations, then those are can be buy the close or sell the close signals, versus those that are between 2 and 3 and 3 and 4, which are typically still going to get some trend resumption, but will have a pullback first. So in this case, you would
this
probably
bar right here be an example where it's possibly too big of a bar, so it may get a pullback and then trend resumption. Bar 45.
It could be. It's honestly a bit hard to call the z-score on. One of the reasons why I like actually calculating it is because visually it can be difficult to identify those thresholds. But when you have a statistically significant large bar at the end of a move, it's typically going to not going to reverse, but at least go sideways. Similar to like if you had a micro wedge, or sorry, a micro gap at the end of a move, you'd also probably look for some sideways trading range behavior.
Certainly. And we actually had a day where, and before I go there, I know we talked about breakouts in one of the prior sessions. And one of the reasons why breakouts and leg counting is so important is here, it's reasonable to say this is a tight trading range or a contracting range. We sold off, rallied, and the range got small. So when you start seeing breakout bars closing above everything, it's reasonable to assume. And James, I'm getting on the topic real quick. I don't mean to shift real quick about the market when the leg count gets reset. And it's reasonable, would you agree that somewhere between 34, 35, that we're getting some reset of the leg count?
Yeah, I mean, so it's easier to do leg count resets manually, like as the human trader. The way that I determined it algorithmically in my leg counting codes was to measure the distance of the the current leg measured from previous spike break to the previous swing point, and as soon as the current leg is more than 50% above the previous swing high, more than 50% of the current leg is more than 50% above the previous swing high, then it qualifies as a potential leg count reset. And so basically the idea is that the breakout is large enough to no longer include that leg in whatever previous price structure the market created. And in this case, you're getting some expansion of volatility, but more or less trading range early in the day, and then return to contraction of volatility, and then expansion of volatility. And so as soon as that volatility begins to expand and to expand volatility but control the bar size, so not climactic behavior, then those are usually very good candidates for leg count resets. I typically don't like to do leg count resets when it's just very single climactic bars, because those can hit those targets but just be vacuum moves.
That's a great. So we've had a lot. I like what you just said. You do not like to give a leg count reset on one bar. Is that pretty much what you were getting at?
Yeah.
And we've had several. If we look back just over, even here, great examples of just big bars and sharp reversals. But I think there was one this day. Maybe this day could work, but it's really not ideal for leg counts getting reset. Even right here, very big bars, but at the bottom of the range, is it fair to say you could say it's a breakout that's strong enough for a second leg, but is where you're getting at as far as one big bar, there's too much risk that it's a trap and it can just lead to more sideways trading?
Yeah, and especially, I would consider this an expanding triangle open. And so the odds are that the day remains an expanding triangle day after an expanding triangle open. And this is, exactly.
And that's what I'm just drawing it so people can see it. It's not a great shape, but the logic of it is what James is getting at. The range is expanding over the short period of time.
Yeah, and it's extreme too, which also suggests that the day can have those same kinds of extreme swings. And so I would not reset a leg count there. Though it probably would be, it would be a leg two actually.
It would, that makes sense. You're saying leg one, pull back, maybe leg two.
On the larger day structure, but even like if you're counting like smaller legs intraday, like 54 up to 56 would be a bull leg, and then you have the bear leg start there when you break that spike, and you don't get another higher high. I don't believe is 60 a higher high. I can't tell.
It's not the lower high.
So then, if you don't get a spike break, then that would be all one leg actually coming down from there. But I think that to your point, the thinking about breakouts as really the starting point for everything, and this is something that Ali focuses on when students ask about where to begin and where to spend their time, and he provides a lot more materials as the session moves on. So whether it's the breakout code to identify the different varieties of breakout bars, or white papers discussing them in greater depth, and giving students ideas about research they can do on their own.
Certainly.
All of those things are great. But prior to giving students any of that, his gentle suggestion is that, we just start thinking about breakouts, because, and this is actually something when we started in PTM, the Pro Trader mentoring, what was it? The summer before SA2 started.
July 22.
I think the first session, they said, everything starts from breakouts. So that's where we're starting. It's like, great. And that's where SA2 starts. And if the market cycle starts with the breakout, then I think that when folks think about their system design, it's the most logical place to begin, because I think if you don't start there, then you can kind of get caught up or lost or lead yourself astray. It's very easy to lead yourself astray when you're developing systems because there's so many different things you could do. But focusing just on breakouts and a reasonable way to trade breakouts consistently gives you so much cover that after that, the other systems are much easier to develop because you're just basically covering the other parts of the market cycle.
That was interesting. So you remember when Al Lee, he asked us a question, why is this significant? And it took us like a week to figure it out, but it had to do with the breakout.
Right.
And he was saying, what is this bar? And finally everyone figured out it's a breakout. But if you go back to one of Al's books, I think it's in all three of them, it's in the introduction part. But he says the single most important question a trader, and I'm going to kind of summarize this, but the single most important thing a trader can understand is, will the breakout succeed or fail? And I thought it was really interesting. Al Lee, he used his indicator, the paint bar that everybody has pretty much with Systems Academy or PTM. And he was showing just how many bars are actually inside bars that are non-breakouts. And when you think about the market, there's 81 bars in a chart. How many bars are actually not breaking out of anything? And if I'm just guessing on an average, it's probably less than 10, maybe 9.
Yeah, but I mean that sounds reasonable.
Yeah, but to your point, that means that there's 81 bars minus 10. There's 71 bars on a chart that are breaking out of something. And therefore, to your point, breakouts have to be the single most important thing to understand. And what you just said is really interesting. If you don't understand breakouts, how will you ever understand the market cycle? How will you understand a trading range? So if you don't know what a strong breakout is, how are you going to know what a weak breakout is? But as you said, if you can figure out what a strong breakout is and build a system on that, you automatically know how to trade a trading range.
Exactly.
Because you can just don't buy the close of it. It's like what you said about the Z-score on that bar 15 today. Don't buy the close, buy a 50% pullback. You're just using your capital or your position size more efficiently than just buying the close. And in trading ranges, that's exactly what traders do. They don't buy the close, they enter the pullback.
And actually, one of the hardest things for me with all of the systems I've developed, it was actually, and where doing the market replay in NinjaTrader helped me a lot, because I was so accustomed to entering on stops and waiting to enter on limits, and being okay with missing trades. Being okay with missing trades was one of the more uncomfortable things that I've had to get used to. And
so why is that? That's a very interesting topic.
Because for me, if I see a trade that I basically, if my system suggests that the trade will perform according to the criteria that I've researched and the signals are being generated from, and my limit orders don't get filled, then the biggest hurdle was overcoming the disappointment of not being able to participate. But that was quickly dashed, or not quickly. It was reasonably dashed by something that Ali shared when I mentioned that to him. He shared that clip from James Bond.
Oh, yeah. What is it? M? Is that her name?
Yeah.
Yeah, I think it's Is it? Oh gosh, what is the?
Disappointment is unprofessional.
Mm-hmm.
I was just like, okay, well, there we go.
Yeah, I'll think of the name of the James Bond. Which one that is?
It was in Skyfall.
Skyfall. That's right. Yeah. Skyfall. Yeah, that. Yeah. You're exactly right. It's unprofessional.
Yeah. So just letting it go. And so now I actually miss probably 3 or 4 trades a day that my limit orders don't get filled. And whatever, that's all right. I just gently channel my inner M and let it go.
So that's interesting because one of the topics that we should discuss for a second, based on what you just mentioned, is kind of goal setting. Is part of the reason why you were quickly, and again, the reason we brought this up is being okay with letting trades go. I think that's naturally a very psychologically challenging thing for most people, just to be okay with watching trades go by and not doing anything. Do you think part of that reason is because through your testing and through your discovery of the system you're building, you understand what the parameters? So if you trade every day, here's how many signals on average you should see in a day. Therefore, if you just follow this rule or this path, here's how it should perform in a given period of time. Did that give you a little bit of peace?
Absolutely. I mean, it's that, and it's because the systems that I've developed and that I prefer to trade are high probability scalping systems, and so they generate enough signals that if I miss three, it really has very little effect on the performance of the system. And chasing signals, makes also actually ended up realizing that it makes me feel equally kind of icky because it does feel unprofessional when you do it, or like the way I was doing it felt
Feels kind of
unprofessional
sloppy,
too.
yeah.
Yeah. So it's nice to be able to let them go and be okay with it.
And I would imagine most of those trades, the goal of that system is to roughly have the same number of, in terms of profit, it needs try to make it about the same. So if you're going for 4-point scalps, depending on the range, 3-point scalps, is it roughly about the same amount of profit on each trade?
Yeah, I mean, it's roughly 1 hour a trade.
So the reason I mentioned that, James said something really important about high probability trades. And scalpers, if you're trying to take, a decent amount of trades and have high probability, one of the things they focus on is variance. So how much variation from their average trade are they taking? So if you look at your average number of trades, what you don't want is you have 10 trades where you make a point, lose a point, you make 10 points, lose 20 points, and then on the final, 9th trade, you made 60 points and, pick a time frame. But the point is, you don't want to have one trade. If you took away that one trade, you would be completely unprofitable for that period of time. That is a damage. That's an issue with the system. And if you listen to the video course, if you listen to Al talks, there's a section in the probabilities and traders equations in the video course where Al talks about how you don't want I think he actually called it Z-score, where if it's really low, if it's a 1, you don't want to have 10 trades all be, small winners, small losers, and then on that 10th trade be the one winner and you had to go to the dentist office so you missed it. And that's reality. So it's really important. A lot of traders focus on trying to take high probability trades with the route about the same amount of points, because as James just said, what if you can only trade half the day, or if you're just taking a few trades in a day? It doesn't matter, because you don't have to cherry pick high probability. You don't have to worry about cherry picking high probability trades. You can trade for the full day, the half day, and it's not going to damage the system.
Yeah, and I think that's one of the things that I realized when we were talking early in SA2 about the different psychology of traders who prefer swing trading and those who prefer scalping. And if you're going to be a swing trader, you have to take all of your signals.
Absolutely.
Yeah. Whereas if you're a scalper, you can miss 3 and be perfectly fine. So it's just a different type of psychology. And for me, I don't like the being in the market as long. It suits me better to enter on limits and be out in 1 to 3 bars at most.
Oh, 100%. And Gabriel asked if I could post a link to the James Bond video. That should be the link. I'm pretty sure it is, but it looks like it is. So watch that sometime. You'll enjoy it. Yeah, no, that's another great point you just mentioned. A lot of traders naturally like to be out within a few bars. And the other portion is the better you understand the system you're working with, and the faster you can get out of the trade, the quicker you can reassess and take a new position. The worst thing let's give maybe a sneak peek into Ali's white paper that he always talks about. But
the breakouts?
Yeah, the breakouts.
Yeah.
I'm going to say just calling it the white paper. Yeah, the breakout research paper. So everyone in Systems Academy or in Orlando, they got the breakouts research paper that Ali he used and built for Orlando and Systems Academy. He's redesigning a lot of it, so he's adding a good bit more information. But anyways, one of the things I wanted to mention with that is Ali talks about, on average, and I'm kind of summarizing here, how many bars, James, let's talk about from a pivot or swing point. So if you have a breakout that, let's say you have a 5-bar bull micro channel, and it's breaking out, and if it's mostly a trading range day, what's the probability that you're going to get a 6th or 7th bar? It's usually going to pull back, right?
Mm-hmm.
So the point with that is by holding on to trades, and you buy the close of a bull bar, and then you've got 2 or 3 bars your way, and you have profit. Most of the time, when you hold on to that trade, you're going to suffer through a drawdown. Even if that drawdown is just open profit of what you have, it'd be a lot more efficient to enter, exit a few bars later, look to enter on a pullback. And that's why a lot of traders naturally, as James was just saying, they naturally want to exit within a few bars because they know that pullback's coming just on almost every time.
Yeah, and it's interesting and probably worthwhile mentioning one of the reasons why you get those pullbacks, especially when you have big bars, is because all of your traders who are trading for those expected, the low variance systems, who want the 1R and who don't want the risk of having, trades accounting for significantly more and needing to, balance out their trading. So, they will be taking profits, during some profits during, and certainly all profits, when that big bar closes.
100%.
Which is why you get those pullbacks. So when you get big surprise bars, people take profits. And so that's what generates those pullbacks. So when you don't get the pullbacks, then those closes of the big breakout will typically operate as support and resistance on a retest.
Yeah, absolutely. Because it should have pulled back and it didn't. So now there's trapped traders, right?
Exactly. Folks who were fading got trapped, and anyone who was in before exited with their profits.
Makes perfect sense. I just want to show this for half a second here, because this gives a small, sort of an example of what James is talking about. When you have a trend, trends, I remember Ali, he used the example of, and this is actually that same day, it's April the 28th of 2022 that we looked on TradeStation. This is that same chart, just zoomed in. And the one thing Ali talks about all the time is breakouts need to be orderly. They need to have an orderly fashion to them. And if you look at this 1-minute chart, you can see how price is contained within 2 lines. But then when you look right here, it's kind of like, James is talking about that example of everybody's holding a position and people become impatient. So when they're holding on to a trade and all of a sudden they get this, as Al calls it, windfall of profit in a few bars, that's multiple times the range of maybe the average bars, everybody's going to take the profits. So this is not what trend traders want to see. Trend traders will, if they do see it, everybody exits the trade. And the counter trend traders, they're waiting for this because they know it becomes more unsustainable.
Yeah, absolutely.
There we go. And again, if anyone has questions, feel free to ask them.
I'm going to come back up.
Yeah, so James, what I wanted to kind of touch back on, goal setting. And that can be something that's very broad. It can be very, some people are very broad with it. Some people are more really in depth with it. But one of the things that traders naturally struggle with is the longer you look at charts, the longer you trade, the easier you get a little more comfortable with letting trades go or just being patient. But it's a very, very challenging thing to actually be, look at a chart and just not have a feeling of anxiety trying to figure out what to do. And what I've noticed is I mean, you're a great example of this. Those that can calm their nerves when they're looking at a chart, they've either looked at charts for a long enough period of time that they kind of understand what's going on and they understand their psychology, or they've kind of trained themselves, for lack of words, to trade a certain style or a certain setup, certain system. They understand it well enough that they're just locked in on this one or two or three ways to trade, and they're comfortable with it. And I see this all, people, I hear people mention this all the time, where they have this, it's almost like an adrenaline rush when they're looking at this chart. And part of the reason is because they have no idea what setups they're even looking for in the first place. They're just looking at the chart with the plan of just trading it. And they're trying to think through the, Al's video course on what to do. But, James, how many times, if you've looked at a chart and you're trading a chart, how have you ever been able to just, let's take your notes of your system. Let's say you're trading the system, it's the morning tomorrow. How often have you been able to pause the market, look through your notes of your system, and decide what to do?
I mean, there's no pausing the market. So
yeah, so you have to know, as Al Lease, he says it all the time to everybody. The trading hours is not the time to work on tweaking your system.
No, you need to have a plan.
It is. It's okay if you're tweaking your system and you're not looking at the market. That's one thing, but you don't get to tweak your system in the middle of, the heat of the moment.
Yeah, it should be. I mean, it should be like he was talking about, recently with, calibrated expectations. I mean,
yep.
You should have calibrated expectations for every signal your system generates, and that's really the value of having a system, is being able to appropriately react to whatever the market does. Like, you have basically a decision tree, and if everything goes according to the way your signal or system suggests it should, then your expectation, you trade accordingly. If you get a big surprise in your favor or a small surprise in your favor, like, there are certain things you should do. If you get a big surprise against you or a small surprise against you, there are certain things that you should, anticipate and know how to manage. And so basically, if you have all of those, possibilities covered, then it really doesn't matter what the market does. You know what you should do, and that gives you, I don't know if freedom is the right word. Maybe it is. It gives you a lot of comfort.
You're. Have you ever listened to Al?
It lets you trade comfortably. Yeah.
Yeah. Have you ever listened to Al or Ali? Al, since we've heard Al talk a lot. Have you ever heard Al be? I'll give you a good example. When listening to Al and Ali at the Orlando event, when they were trading in front of everybody and they're talking, you can see when the market. I remember there was an example. They were both long. I can't remember the exact, the chart, but I remember they were long. Actually, if we have a second, I can just show it right here, because it'd be an actual very interesting example of calibrated expectation.
While you're pulling that up, I mean, I remember one day in the trading room, Al faded a wedge and a third leg in a wedge, and it got a breakout in the direction of the trend. Mm-hmm. And totally calm, just bought here on the breakout, and he narrated, and it went against him like 5 bars. He bought again, and then got out break even on the first with profit on the second too, and just never any kind of fluster. It's just expectation, calibrated expectation.
Yeah, but his voice isn't trembling and he's not sweating and just panicking. I remember it was funny listening to. So those of you that were at Orlando, you will actually remember this to a degree. So James, this was the day, and we had a big sell-off, big rally. And if I remember correctly, I might be slightly wrong, a tad, maybe within a bar or two, but both Al and Ali were long right here on bar. Let's just say bar 34. And their stop, their stop is somewhere like just down here. And I remember watching both of them. You kind of see it on their faces. They were very calm. 34 happens. They bought more somewhere over here. And then they both had limit orders to buy at the low of the day. And I think maybe one's lower. I might be exaggerating a little. Maybe they bought once or twice down. But when they saw 36, there was not the look. And again, they were in front of everybody. So it's nothing like, full pressure. Everybody's in a room watching you trade this chart. They were both very calm on 36. No one's panicking. And it was a great example. They both were very confident, consecutive sell climaxes, trading range day. James, you talk about big bars. I'm sure bar 36 is a big Z score.
Yes. Yeah, absolutely.
So big Z score. James, you mentioned earlier that big breakouts typically don't shift the always in direction. Here, it's a trading range. So maybe if 30, is it fair to say, James, if 37 was an equally big bear bar, that Ali and Dow would probably be wrong?
Yeah, I mean, that would be extreme.
If you had a bar somewhere down here, sure.
Yeah.
But that's not enough. And then both of them held and got out somewhere over here at their original entry. But I thought it was a really interesting example of just how calm they were.
With profit on the other 3 entries.
With profit on the other 3 entries. I remember Al bought above this bar, and I think Ali, he bought somewhere during the bar, but they were both just very calm about it. There was no, they weren't eagerly, they didn't sell this close because I'm sure kind of James, as you mentioned, the Z score, big bar. But the point is, back to James, really back to what we were just talking about, James. Let me get this moved over. Their calibrated expectation on what the market should do is what kept them in the trade. And that's the key. And, the amount of, we see this all the time. People will be watching the market, taking trades, and they have literally no idea what their expectation of the market is. And that's a very dangerous way to trade. There's almost you shouldn't even trade that way. And, and that's why a lot of traders, everyone's had the feeling of fear or panic, and some sort of kind of anxiety when you're in a trade. And the reason is you don't have a strong enough expectation on what the market should do. So if you just even go back to this chart, if I'm going to share this for one last time, if you sold the high of this bar thinking bear breakout on bar 6, James, you know this, bear breakout. If you sold the high of this bar hoping for a second leg, bar 7 is not the bar you should, you're not hoping for bar 7. And if you're aware of that, it's reasonable to just reverse your position.
Yeah. And there are a number of reasons on that chart why, you wouldn't want to sell above that bar.
Of course.
But I think that, the larger principle here of the calibrated expectation is really key, because it also takes, and this is, we mentioned it before in Ali's How to Become a Professional Price Action Trader article. He talks about intentional practice, and if anyone here is familiar with the Brooks Encyclopedia, why do we have all of the failed and successful patterns of both bull and bear patterns?
Right.
It's because you have to be able to calibrate expectations for all of those possibilities. And it's the same thing when you study a system, when you study a setup and develop a system around it. You need to look at arguably between 400 and 800 charts, to really internalize all of the nuances of that system in order to have properly calibrated expectations. So it takes a lot of time, but once you do, then you can trade with that kind of ease, because it doesn't really matter at that point what the market does.
Oh, absolutely. And one thing James mentioned is you need to look at, hundreds of charts. That does not mean looking at hundreds of charts is not just, okay, I'm going to open TradeStation and just go back on 100 days and understand it. That is, Ali, if you ask Ali, looking at a chart, just staring at it is a waste of time. He's a very big proponent, and you have to be looking at something. If you're doing market replay, you've got to be trading market replay for a specific reason that you're trying to accomplish. It's not just, I'm just going to replay this day and retrade it for fun. And when you're looking back at charts, you have to have an actual reason. Okay, I'm setting this breakout and follow through when if James is looking at Z-score, when the Z-score is in this range or it's a wedge bottom. There's got to be an exact reason. I posted, here's the links to the white paper. You can go ahead and click on that. And that's the white paper. That's not the white paper. That's the article Ali wrote in January of 2022. And there's some great little nuances about Ali's viewpoint on everything that traders have to go through and kind of that spiral of learning, which, James, I'm sure you're really familiar with, given your background.
Yeah, I mean that spiral of learning and whether it's mentorship or self-directed learning, I mean, and that self-reinforcing those positive feedback loops are incredibly powerful. So once you've really studied 400 or 500 charts, the nuances really become much more significant, and that's where you can see significant improvements in the way that you actually trade, enter and manage positions, because
100%.
It's all those nuances that really define the greater edge of a system. A system can have, or it has to have, an edge, which is like Al says, it's just a mathematical
expectation.
Right. Exactly. It's just math. But you can improve that edge significantly by optimizing once you better understand the nuances. And they are, some of those nuances are very, very fine, and take a lot of time and study to internalize and then practice to trade, because you have to develop muscle memory to actually execute on those nuances. So that's where replay comes in after doing all the study. So it's quite and this is why SA2 is a year-long program. So it's a substantial amount of work.
So could that be why Al says beginners should focus on 1 to 3 setups?
Absolutely.
Because of what you just said, all the nuances that go into price action as a whole, if you can figure out 1 or 3 setups much faster than let's just trade 40 different ways and see how it goes.
Exactly.
And someone asked, I want to comment on this question here from Jay Haas. And in order to do that, I want to share a chart, an example here. So let me take a quick second here.
While you're pulling that up, I'll just say he says, without giving too much info away, there's no secrets. Everything, and this is one of my favorite things that Al says. Everything here is totally free and totally transparent. All the information is out there. It's just a matter of figuring out how to apply it for yourself. What makes the most sense for you, and that's really where the effort is. Because it's very personal, and that's the struggle that most people, I think, end up having, and perhaps where Systems Academy really helps, because it is very particular to the individual.
Absolutely. And to James's point, I would argue the reason. So I'm going to pull up your question here. I've gone through the Brooks trading course without giving too much info away. What's your advice? I hear you talk about focusing on breakouts. Would this be where to start? Yeah. One of the reasons why, the Brooks trading course, if we think through, I do not know of any trading course or trading material that is more in depth than Al's. From just a pure knowledge standpoint, I don't know anybody that's written books that large, that 3 volume set plus the blue book, plus there's 120 hours of the video course. If you include the 2014, 2013 course, I'm pretty sure that's 60 hours of videos at least, or 50. So there's over 200, there's almost 200 hours of videos plus all the webinars. The point is, here's the issue that traders face when they're trying to figure this out. And it's the path of learning. This is a slide Ali drew up. And most courses end up failing really for the simple reason of this top part. You can have the greatest material, and James, you've been a teacher or an educator in the past, and I'm sure you can explain, you could touch on this. You can explain something in the best way. You can hold someone's hand through life. You can try to give them as much help as possible. But at the end of the day, it's up to them, right?
Yeah.
And the reason I bring that up is you can have the Brooks trading course, you can study it as much as you want, but it's still up to the individual to be able to structure their time in the right way, to practice what they're learning, and also how you're going to build, if you're going to build a trading environment or a trading system, how are you going to build it? What are you going to do? There's no one there to help you learn that. And that's the difference with Systems Academy. Systems Academy is really designed for people that have already ideally studied the video course of Alice. They understand it well enough where they can talk back and forth about it. They could sit with James and I and they can talk about a chart. They understand it. The difference with Systems Academy is everything we've talked about. It's this bottom portion. You're going to understand what a system is. You're going to research the system you're building. And that's going to take, it's a year-long process. And the key is really the bottom part, working under supervision. So it's actually getting feedback and help. But if you're back to your question, Jay Haas, how do you progress if you're studying the Brooks trading course, what do you do to really progress? What I would tell you is you have to figure out a way to build a system. You've got to either do that yourself. We're here to help. But at the end of the day, the fastest way to figure things out is to build a system. I would start breakouts is a good idea. Breakouts, ideally, here's a good system that everyone can think about. Figure out how to define leg one. So go through the market cycle, figure out how to define that. Look for breakouts, define what a breakout is, and trade the second leg. If you can accomplish that, you will find high probability trades. And as James has heard 1,000 times from Ali, just don't trade the third leg. If you can focus on trading the first and second leg, be careful about trading the second leg and just don't trade the third leg, you're going to solve a lot of issues. And there's other pieces to that, as far as, but the more you can define of what you're doing, you can figure out your stop placement, what's your target. Do you scale in? Do you scale out? But the reason why traders have so much trouble is if we wrote down on a sheet of paper all the questions we have to ask, am I going to buy the close, sell the close? Am I going to buy on a limit order? Am I going to enter on a stop? Where's my target? How much risk? Do I scale in? Do I scale out? And that's before you've even thought through the market cycle. So when you really think about, it's always kind of fascinating. I'm a visual person, so I like to really think through, how many questions do you have to ask yourself on one bar? Whether, if you're going to trade the first, if you're going to trade the open, you're going to trade bar one of the day. How many questions do you have to go through in order to decide if you're going to take that trade? And it's a lot of questions. And so most people, they get overwhelmed from the video course because there's 120 hours of information, but they don't know. It's too much information for them to digest subconsciously. But they can take small pieces. For example, James, is it fair to say, do you think someone could become really good at trading major trend reversals if they thought through it in a systematic way? Like if they were only going to trade major trend reversals?
Yeah, absolutely. It's
is that any different though than trading a breakout system? Or is the logic's the same though, isn't it? If you're talking about building it.
Yeah, the logic. The construction process is the same, but like because major trend reversals,
performance is different.
Yeah, the performance is different. They happen less frequently, so it's more of a swing setup than like unless it depends on what time frame you're looking at, I guess. But you're not going to get major trend reversals as frequently as you get breakout and follow through setups. And
certainly,
your major trend reversals, like your lower high or higher high, major trend reversals, the expectation is typically your leg two test also. Of the previous direction and then trading range. It's not, the odds that a major trend reversal breaks out from that trading range and gets a measured move down is much lower than, transition into trading range. So it's, those calibrated expectations are important at that point.
100%. But you could take a major trend reversal. If you could understand minor and major reversals, Then all of a sudden, what if you could figure out when a minor and major reversal is happening, and then if you could understand that, the chances of finding a strong breakout go way, way up.
Yeah, absolutely. And this is kind of why I put together that trend and trading range code, because it's so. If you're looking at breakouts and all you want is to identify breakouts that have a high probability of generating a second leg, then also understanding whether those breakouts are breakouts within trading ranges or trend bars within trading ranges versus breakouts of new market structure. So basically, is the market in breakout mode and breaking out, or is the market breaking out within a trading range for a pullback? So there's
two very different things.
Exactly. And so it's difficult to filter those, because if you're just looking at breakout and follow through, you will often get those as part of a pullback structure, rather than and trading those directionally for continuation can be problematic. So there's definitely a lot of scaffolding that needs to go into those systems, and regime filters are good places to start. But yeah,
100%.
absolutely.
Here's a question. How much time did you spend to prepare your trading system based on the breakout idea?
Do you want to take that? You want me to take it? I think the
well, I think the first piece, and James, I'd say the first piece is on the first system you're building. The hardest part is, the first question is, do you understand yourself well enough as a trader to know what system is going to suit your personality? So, for example, I might be a great trend follower, but I may hate buying with limit orders against a move. So fading might just be out of the question for me. And if I'm trying to build a system where I'm fading, let's say, James, I think you actually built a system on this where the Z score is high. So it's a big climactic bar. So it's a big bull bar. And when you can see the big bull bar and it's a high Z score, instead of buying the close, I'm going to sell the close for a scalp. Didn't you build something like that?
I did. And it was very
unnerving.
Like
the system. It worked, but you didn't like the system, did you?
No, I did not like trading it. And it was not a fun system to trade at all.
So the sooner you can figure out, okay, I know I want to trade, for me, I knew I wanted to trade breakouts at least in the first leg. So kind of that always in flip. And that's just something I've looked at a lot of always in from the stand. For those of you that study Al, I've looked at a lot of just always in examples. And I knew that, okay, breakouts in the first leg, high probability of a second. So that's got to be the starting point. But when you start to just get some basic filters, how do you define a market regime? How do you define the leg count? How do you define a strong breakout? You can build it relatively quickly. And then once you figure out that breakout idea or breakout system, and you prove to yourself that it's valid or statistically valid, once you have that, all of a sudden you start to be able to think, okay, well, if it's a trading range and I have a breakout, instead of buying the close, I can buy a pullback. So and James, I think you mentioned this in one of the first videos we talked about. You were talking about your I1R system and how once you built it, you were able to piece together a couple of systems relatively quickly once you had that first idea really formulated.
Yeah, sorry, I was bringing up the trend and trading range bar finder here, and was having an absurd amount of trouble with it.
No, feel free to share it if you want.
But so the I1R system, I did 3 passes on that. So 300 forward testing trades, many more hundreds of visual manual backtesting trades, and the nuances that arose from that. And actually, I've talked with a few incoming SA2 students about that process when they were asking about where to start and the kinds of variables they should look at. And in reality, I collected data on 30 different data points, but most of them were not statistically significant enough to have any improvement on the performance of the system at all.
What was the most important? Can you share what the most important data point was?
Yeah,
Maybe
yeah.
the most like the top 2 or 3.
Yeah,
If you can
absolutely.
just describe it.
I can show it here. Because once I had those, I ended up coding for it, and that way it's just easier to see.
Yeah, just share it, and then we'll throw it up on the screen.
So, two things are most significant: breakouts of the EMA and breakouts of previous swing points, of previous counter trend swing points. So, or previous legs. So here, like for example, this is a breakout of both the previous leg and the EMA. So it's colored this dark green because there's 2 different greens there. And then the indicator draws the pullback levels at 30, 50, and 70%, because those are where I found the most statistically significant locations for entries on pullbacks. So you could start buying at 30 and then add at 50 in a strong trend. Here, this is a breakout of the previous leg, so it gets colored. This is a breakout of the previous leg, and then this bar is part of the I1R, and it breaks out from the EMA. So this is meets both of those criteria. This one is just a breakout from the previous leg, but both this and this are leg 3s. So, and this is obviously climactic as well. And so and this is part of my research, these are not trades for continuation. I mean, yes, you could have sold this 50% pullback and gotten out close to the low. But that's not as like here, you couldn't do that. If you bought this 50%, you're not getting out break even or anywhere near the highs.
Yeah,
so
you're definitely in trouble.
It's just not worth it. And this is again a good exercise in letting trades go. When you get those in leg 3, just don't trade them for continuation, unless you get a breakout in the direction of the trend and you get the acceleration of the trend. And in that case, you can enter on a pullback at that point. But here's another good example of I1R in leg 3. Here's another I1R in a leg 3, climactic leg. And here's what's interesting. This is an I1R, but it gets a 70% pullback. This is an early signal that you're going to have a trading range for a while. Because if a strong breakout leg gets a 70% pullback, then you still have, I think, over 60, almost 70% chance of getting out break even if you buy the 50%, buy 70%, and then scale out. However, this then sets up trading range behavior because a 70% pullback is not a trend channel.
It makes perfect sense. Disappointed bulls.
Exactly. So they'll be getting out, at those highs, and anyone who bought that high is, getting out before there. But the research and the calibrated expectations went into designing the filter for it. So it shows you whether this is doing something statistically significant, and here it was as well. But again, these are now climactic legs in a trading range. So again, calibrated expectation comes in, and you treat them differently than if you were in a trend. Flat EMA is breaking out from the EMA, but it's not a trend yet. So not a great pullback setup.
Certainly.
I'll stop sharing here. But my experience with the research was that the simpler I could keep it, the better. Having 4, 5, 6. I mean, you can always add filters to attempt to improve the performance of the system. But for me, having just those 2 was more than enough.
And James, wouldn't you say that, this is something that's even talked about in Systems Academy, there's a certain level of, I'm forgetting the term exactly, but if you have, let's say you have 10 filters, 3 of those filters might be significantly more important than the rest of those 7.
Yeah,
And
that's
if you
the
just
Pareto
associate
principle.
those, yeah, go ahead, degrees of freedom, right?
The Pareto principle is
Yeah,
the
thank you. Yeah,
yeah.
I'm blanking on it's late. Yeah,
Yeah.
exactly. And you can code for a lot of different filters. But if you're just looking at a chart, and this is everyone I want everyone to understand, if you're not coding and you're just looking at a chart, every filter, every mental filter you have, there's only so many things you can think about at a given moment. So if you're thinking about this and then this filter and then 4 other filters, you're not going to be able to even think straight. So it's
Right.
very important to figure out, okay, I remember Ali time and time again in the classrooms of Systems Academy. He would always, someone would be researching whether it's micro channels or breakouts, and he would always go back to the same question. How are you filtering for leg counting? And I think he just flat out told everybody at one point, he said that if you can stop taking the third leg and take the first leg, whatever system you're building that has to do with breakouts is probably going to improve by 20 or 30%. Just simply taking the first leg. So
Yeah.
learning to filter, keeping things really simple is far more, understanding what leg you're in is far more important than, do I buy the close? Do I buy a 10% pullback or 5, whatever percent pullback? Because that will give you so much information. Or, if it's, I always think back to the micro channel. Ali has that micro channel strategy where it's a 3-bar micro channel, and then you have those 10 filters or guidelines.
10
And
plus 2.
10 plus 2. Thank you.
Yeah.
And
Even more.
But can you really think through all 10 of those if you're just looking at a chart?
No way.
No way. But you can think through at least maybe 2 or 3 of them.
Yeah.
And that can get you pretty close. That can get you pretty close. So when you think about a systematic trader, you think of someone like Ali or you who's programmed something to, everything that they're doing. And you think of someone like Al who is just using their eyes looking at a chart. You might, someone like Ali or you might have a very specific answer for what the probability is for this exact setup. Al is going to look at it and say, okay, well, this is close enough. So it might be, is it 60%? Is it 65%? Who cares? It's going to have a second leg. And the reason for that is when you're just looking at a chart, you have to have some flexibility. You can't be as precise as you could be with an algorithm, but you can still get to the same answer. And that's what I thought was fascinating. Even just watching 2 traders, Al and Ali, trade in Orlando, they had the entry points were a little bit different, but they were in the same direction.
That's fascinating.
Yeah. That certainly is. So it's getting kind of late for us. What, if anybody, maybe James, we can give 20 or 30 seconds and just see if anyone has any final questions. Otherwise, we'll wrap it up. Or James, if you want to say anything.
Well, if someone does have a final question, it might be actually a good starting point for the next session.
Yeah, that's so. Let's see if there's any. That's a great point, James. So I think we talked about doing a session, maybe a short session tomorrow.
Yeah, we were talking about doing one tomorrow where we just pick one thing, one of the price action setups during the day, and just quickly, go through how we managed it and call it a night. Don't have the time for.
You got to make it a little shorter.
A long one.
Yeah. So maybe here's an example. Here's one question about backtesting second entries. Maybe we'll talk some about this on tomorrow. And let's see. Go ahead.
Yeah, no, I mean, I think that'll be a good one because we can take an example of a second entry from, when you say second entries, you mean pullbacks for continuation, for trend resumption, I assume?
I would assume that's what they're talking about.
Yeah, okay. my experience, just real quick, with going for 2R, most of my I1R data suggests that getting 2R is very low probability. So most of my exits in the I1R system are actually at the previous swing point. So entering at 50% pullback, or 30 or 50% with an exit at the previous swing point. So you're going for 1R. So your stop is below the signal bar and of the I1R signal bar, and your take profit is at the previous swing point. So just between now and tomorrow, it might be worthwhile just thinking about whether it's not the setup but the target that's actually reducing the profitability of it.
Very, very well stated. So one thing James is saying is a lot of stop entries, when they trigger, they don't immediately go in that direction. They often pull back. So instead of buying above the bull bar, let's just assume bull bar for a stop entry, you can buy on a limit order and get a better entry, maybe 50% of the bar, which then it's a lot easier to get 1 times your risk or 2 times your risk.
Yeah,
here's a couple of more. Yeah, and then Jay Haas, you asked where you put your initial stop, what is your risk reward, and how you manage that, please, if you could tomorrow. Well, Jay, we can talk some about that, but unfortunately, that is very much dependent upon the way you're trading. Is it a breakout? Is it what leg is it in? What's the market cycle? But yeah, we could give some examples. Maybe, James, this might be a good time. We'll look at a chart and maybe we'll talk about a few examples of breakouts and how we can manage the trade.
Sure. Yeah, I think that's a good idea. We could take a few of those from tomorrow.
Cool. So yeah, we'll make note of those, and we'll see everyone that watches tomorrow.
Awesome. Have a good night, everyone.
Thanks. Have a good night.